Welcome back to ActioFin. In episode 1 we said the controller's superpower is breaking the average apart. To do that you need to know what things actually cost. That is cost accounting, and it is the subject of this episode. We will answer a deceptively hard question: what does 1 unit of your product really cost to make? Get it wrong and you will price badly, drop the wrong line, and chase the wrong customers. Get it right and almost every other decision becomes easier. Here is the route. We separate direct costs from indirect costs. We meet cost centers and cost objects, the plumbing of any cost system. We tackle overhead absorption, the part everyone finds slippery. We compare the two great methods, absorption costing and marginal costing, and see how they give different profits from the same facts. We work through a bakery example. And we finish with what to remember. The first distinction is direct versus indirect. A direct cost is one you can trace cleanly to a single product. The flour in a loaf of bread, the wood in a chair, the hours a baker spends on one batch. An indirect cost cannot be traced to 1 unit without guesswork: the bakery's rent, the branch manager's salary, the electricity that powers the whole site. Direct costs are easy and honest. Indirect costs, which we also call overheads, are where cost accounting gets interesting, and where most mistakes hide. There is a second classification worth knowing, because it controls when costs hit your profit. Product costs are the costs of making the goods, materials, factory labor, factory overhead. They attach to the product and sit in inventory until the item is sold, only then becoming an expense. Period costs, like head office admin and selling expenses, are charged in the period they occur, regardless of sales. Why care? Because if you misclassify a selling cost as a product cost, you park it in stock and quietly overstate this period's profit. The line between product and period is not academic, it is where a surprising amount of profit manipulation, accidental or deliberate, happens. A warning about that fixed versus variable split from episode 1. Fixed costs are only fixed within a certain range of activity, called the relevant range. Within it, rent and supervision do not move. But push volume far enough and they step up. You need a second supervisor, a second oven, a larger unit. These are step costs, and they catch managers who assume a cost will stay flat forever. So when you model a big jump in volume, never blindly hold the fixed costs constant. Ask where the next step is, because crossing it can wipe out the profit the extra volume was supposed to bring. Cost behavior is a tool, not a law. To handle overheads we use 2 ideas. A cost center is a place where costs accumulate, a department, a workshop, a single machine. A cost object is the thing you finally want: the cost of a product, a customer order, a client. The whole exercise is moving money from cost centers onto cost objects in a way that is fair and useful. When that flow is sensible, your product costs are trustworthy. When it is arbitrary, every downstream decision inherits the error, quietly. Overhead absorption is how we spread indirect cost across products. You choose an absorption base, also called a driver, total labor hours, machine hours, or units produced. Then you divide the overhead by that base to get a rate. And you apply the rate to each product according to how much of the driver it uses. Here is the catch that trips people up: the driver you pick changes the answer. Spread overhead by labor hours and a labor-heavy product looks expensive. Spread it by machine hours and a machine-heavy product carries the weight instead. The cost is partly a modeling choice, not a fact of nature. Sometimes a single overhead rate is not just rough, it is actively misleading. Imagine a factory where one product runs in long, simple batches and another needs constant machine setups, inspections, and special handling. A plant-wide rate based on labor hours would charge them almost the same overhead, which is plainly wrong. Activity-based costing fixes this. You identify the real activities that consume resources, setups, inspections, deliveries. Work out the cost of each, and charge products according to how many of those activities they actually trigger. Suddenly the fiddly, low-volume product reveals its true, much higher cost. And the simple high-volume one looks cheaper than the crude method suggested. Activity-based costing is more work. So reserve it for businesses where overheads are large and products differ sharply in how they consume them. There are two main methods, and they disagree on purpose. Absorption costing puts direct costs plus a share of fixed overhead into each unit, which means unsold stock carries some fixed cost on the balance sheet. It is required for statutory accounts. Marginal costing puts only the variable cost into the unit and charges all fixed overhead to the period. It is far better for decisions. The surprising result, when stock is rising, absorption costing reports a higher profit than marginal costing from identical facts. Simply because fixed cost is parked in inventory. Knowing which lens you are looking through stops a lot of arguments. Let us make it concrete with Halden Bakery. One sourdough loaf takes 40 pence of ingredients and 25 pence of direct labor, so 65 pence of direct cost. The bakery's monthly overhead, rent, ovens, the manager, electricity, is £18,000. It bakes 40,000 loaves a month, so overhead absorbed per loaf is 45 pence. Add it up and the full absorption cost of one loaf is £1.10. Simple enough, until the owner asks a decision question. A café offers to buy spare loaves at 95 pence each. Looking at the full cost of £1.10, the owner nearly says no. It looks like a 15 pence loss per loaf. But that is the absorption trap. The overhead of £18,000 is already being paid whether or not this order happens. The relevant cost of one extra loaf is just its marginal cost, 65 pence. At 95 pence, each extra loaf adds 30 pence of contribution toward fixed cost and profit. As long as the ovens have spare capacity, the owner should accept. Full cost is for valuing stock, marginal cost is for deciding. The numbers settle it. Marginal cost is 65 pence, the café pays 95, so each spare loaf contributes 30 pence. If the bakery has 5,000 loaves of idle capacity a month, that order adds £1,500 of profit straight to the bottom line, with the fixed overhead already covered by the core business. Refuse it on full cost reasoning and you leave that money on the table. This single distinction, full cost versus marginal cost, pays for an entire cost accounting system. Once you have separated fixed from variable, one of the most useful numbers in business appears almost for free, the break-even point. It is simply fixed cost divided by the contribution per unit. For Halden Bakery, fixed overhead is £18,000 a month and each loaf contributes about 45 pence above its variable cost. So break-even is around 40,000 loaves, almost exactly what it bakes. That tells the owner the business is running close to the line, with little cushion. Sell 10% fewer loaves and it slips into a loss, 10% more and profit climbs fast. Every owner should know this number for their business, and it is a controller's job to put it in front of them. 3 mistakes to avoid. First, pricing every decision on full cost. It is right for valuing inventory but dangerous for one-off orders, as the bakery showed. Second, using a single overhead rate for a whole factory. It blurs which products truly consume resources, departmental or activity-based drivers are sharper. Third, forgetting capacity. Marginal reasoning only holds while you have spare capacity. Once you are full, the real cost of accepting an order is the contribution of whatever you must turn away. The opportunity cost. One practical wrinkle. You set the overhead absorption rate in advance, from a forecast of overhead and volume. Reality rarely matches the forecast exactly. If you make fewer units than planned, you absorb less overhead than you actually spent. That is underabsorption, and profit is overstated until you correct it. Make more, or spend less, and you overabsorb. At period end, the difference is written off to the profit and loss as an adjustment. It is not a disaster, but a controller who ignores a large absorption variance is hiding a real signal. Either the forecast was off, or volumes have shifted. And either way, the costing model needs a refresh. Finally, a bridge to what comes next. Once you can build up a product cost, you can set a standard cost. A carefully agreed statement of what one unit should cost, given efficient operations and expected prices. It is not a guess, it is an engineered target, built from expected material quantities, labor times, and rates. The standard cost becomes the benchmark for control. In episode 4 we will compare actual costs against these standards and analyze every difference. So the costing discipline in this episode is not an end in itself, it is the foundation that makes real performance measurement possible. Master the cost, and you can finally manage it. To recap, direct costs trace cleanly to a unit, indirect overheads must be absorbed using a driver. And that driver is a modeling choice that changes the answer. Absorption costing belongs in your statutory accounts and stock valuation. Marginal costing belongs in your decisions, especially pricing and spare capacity orders. Hold both lenses, and always ask which question you are really answering before you quote a cost. Now that you can cost a product properly, the next episode builds the plan that uses those costs, the budget. We will assemble a master budget from sales right through to cash, and see how the pieces lock together. The full course, with calculators and practice cases, is on ActioFin.com. See you in episode 3.